Let me express my gratitude to the Kenya Bankers Association for the invite and organizing this launch event. I know that the campaign themed Claim Your Financial Freedom is designed to empower individuals and businesses in the economy with knowledge and skills necessary to make informed financial decisions on banking, insurance, and pension services. I'm also informed that today's launch will pave the way for a month-long sensitization drive focusing on building a saving culture and financial planning. And this will in turn enhance financial health of businesses and also households. Before delving into the theme of today, let me briefly set the context in which we meet this morning. Globally, growth has continued to recover, while inflation has moderated but has continued to be sticky downward in advanced economies. I think just on that, on a more serious note, inflation in the World Economic Outlook of April, the IMF estimated that inflation would decelerate from 6.8% to about 5.9% this year. And the stickiness is really when we look at let's say even the inflation in the US, which now is 3.4. The core inflation in the US is still 3.6 and has been 3.6, 3.8 for quite a number of months. And their target is to go to 2%. So that is the stickiness we are talking about. And that stickiness then results in elevated interest rates and a slowdown in the pace at which the Fed will lower interest rates. So this generally positive global outlook is subject to downside risks, mainly from a potential escalation of geopolitical tensions, and if interest rates remain higher for longer to fight the sticky inflation rates in the advanced economies. Domestically, we have experienced relative macroeconomic stability this year, with the inflation oscillating around 5% in April and May, which is a midpoint range of the central bank. The foreign exchange market has also stabilized and is one of the best, if not the best, performing currency this year vis-a-vis the major currencies. On the growth front, the recently released economic survey of 2024 shows that the Kenyan economy recorded very strong growth in 2023 of 5.6%, driven by the rebound in agriculture and, of course, a robust performance in services, including the finance and insurance sector. For those who have looked at the details of the growth, you'll see that actually finance and insurance grew by 10.1%, which was a very strong performance, and only outdone by the accommodation and tourism sector, which grew by almost 34%. So while the recent flooding in parts of the country caused considerable damage to lives and livelihoods, the economy is expected to remain very strong in 2024. This will be supported by the resilient services sector, continued robust performance of agriculture, and implementation of the government reforms targeting priority sectors under the bottom-up economic transformation agenda. Turning back to our theme for today, the finance and insurance sector continues to be one of the key services sector driving Kenya's economic growth. But much more can be done to expand the sector and further catalyze our country's growth. As you can appreciate, the finance and insurance sector is indeed the engine of the economy, given its pivotal role in financing all the other sectors. And therefore, financial inclusion is critical for sustained and inclusive economic growth. In this context, I'm glad to note that access to financial services has expanded threefold, from 26% in 2006 to 83% in 2021, based on the 2021 FinAccess Household Survey. We are currently in the process of updating the FinAccess Survey and look forward to the updated results later this year. The FinAccess survey for 2021 revealed that while progress had been made in financial access dimension, with 83% of adults accessing financial services, much more remained to be done in the usage, quality, and impact dimensions. This morning, I'll focus on the impact components, which refers to the financial health, and ultimately financial services and products have to impact on the livelihoods of those using them, thus the criticality of financial health. So the 2021 survey employed a framework of financial health constructed from three main life goals. First was the ability to manage day-to-day needs. Second is the ability to cope with shocks. And third is the ability to invest in future goals. The aim of the survey was to determine the outcome of financial inclusion in terms of the resilience of the Kenyan population and its potential for growth. The results of the survey indicated that the financial health of respondents deteriorated to 17.1% in 2021 compared to 21.7% in 2019 and compared to 39% in 2016. This implies that 17% of the respondents could adequately and comfortably meet their day-to-day needs, cope with shocks, and had the ability to invest in future goals like saving for old age. The main driver of this deterioration was the inability to cope with shocks and challenges in managing their day-to-day needs. This deterioration was amplified by the COVID-19 pandemic that was at its height in 2020-2021. So the timing of this financial literacy campaign that you are about to launch today is therefore apt as we seek to enhance the financial health of our citizenry and businesses. Allow me therefore to highlight three broad areas that we can reflect on as we launch this campaign. First is customer centricity. I'm pleased with the participation of a diverse set of financial sector players, including the banks, insurance companies, microfinance banks, mortgage refinance companies, and the payment service providers. It is imperative that the products and services we provide cater for the needs of customers. In particular, they should cater for their day-to-day needs, enable them to cope with shocks, and provide them with the ability to invest in future goals. These will entail financial products and services ranging from transaction and savings accounts, microcredits, microinsurance, to micro pensions. My challenge, therefore, is to financial institutions to truly reflect on whether their products and services meet the financial health needs, particularly of Kenyans at the bottom of the pyramid. Second is the confidence by customers in financial services. There continues to be a high number of complaints from customers on the high cost of financial services, unsatisfactory customer services, poor customer experience, and lack of transparency and disclosure. This, coupled with the growing fraud incidences with increased digitalization, are eroding confidence in the financial sector. It is imperative that financial services providers rationalize their cost, enhance customer service and experience, and scale up transparency and disclosure of their terms and conditions. Additionally, raising awareness among customers on emerging forms of fraud, including social engineering and identity theft, is imperative. Third is sustainability of initiatives such as the one we are launching this morning. Oftentimes, campaigns such as this last for a given duration of time and thereafter become dormant. Subsequently, the impact of such measures is not discernible in the medium or long term. I'm pleased to note that today we have stakeholders from the financial sector, consumer organizations, and persons with disabilities. I trust that the partnership forged today will lead to a more sustainable partnership beyond the 1 month duration of the campaign. The Central Bank will be keen to engage with the stakeholders here today on how we can create the sustainable framework to coordinate financial literacy efforts on an ongoing basis. So as I draw to a close, let me reiterate that this campaign is an important plank in Kenya's quest to build on the financial health of its citizens. Let us build on this to move forward the financial inclusion frontier as a pathway to shared prosperity for all Kenyans.